Hello, and thank you so much for joining today's launch of our new initiative, Talent Finance, an effort that we really hope is going to spark a change in how we think about investing in and preparing our workforce for the future. You know, pioneering solutions to workforce challenges has been a long-standing priority for both the Chamber and the U.S. Chamber Foundation. We all know that jobs are changing rapidly, and the skills required to fill those jobs is changing just as fast. That trend was already underway and certainly accelerated by the pandemic and the recession and the outlook over the last 6 months. Many workers have seen their jobs go away as a result of the pandemic without any assurances that they're ever coming back. And many students are facing an uncertain and equally unpredictable job market now and into the future. Long before the pandemic hit, the Chamber has been working to address these challenges and build the talent development systems of the future through programs including Talent Pipeline Management, the Job Data Exchange, and the T3 Innovation Network. Through these programs and more, over the past 6 years, the Chamber's Foundation, the Center for Education and Workforce, has been focused on giving employers the tools they need to manage their talent pipeline. It's meant aligning education to meet the needs of real-world careers and ensuring that workers have the skills necessary for the jobs employers are actually trying to fill. But over the past few years, it's become clear that we also need to rethink how we finance the education and training necessary to fill the talent pipeline. And that's where talent finance comes in. The current higher education system has left Americans with a record $1.6 trillion in student loan debt, second only to mortgage debt. Individuals and families assume the bulk of that debt, and the majority of it is backed by taxpayers. And of course, even with the degree, workers can face a great deal of uncertainty when it comes to advancing their employment and their earnings. In many ways, we're currently digging ourselves into a deeper hole rather than leveraging the potential of education to lift our country up. Today, we're starting a new conversation about the potential for our education system. And more than just outlining the problem, Talent Finance proposes actionable solutions. We need to leverage the strength of the public and private sectors and encourage them to work together rather than in continued silos. We're also calling on employers and the financial services sector to play a more proactive role in investing in and building the workforce of the future. And our new white paper considers innovative approaches to financing, such as income share agreements, career impact bonds, and lifelong learning accounts. Now we must begin the task of bringing that paper and its many recommendations to life. Like any catalyst for meaningful change, this must be a unified effort. Workers, families, employers, and the government should all have skin in the game. These lofty goals cannot be achieved alone, and I want to just take a quick moment and thank the people who have helped us so far. In addition to the U.S. Chamber of Commerce Foundation, Talent Finance is brought to you by the Federal Reserve Bank of Atlanta, the Greater Houston Partnership, and Working Nation. It's made possible by the generous contributions of our funders, including Jpmorgan Chase, Microsoft Philanthropies, Cognizant Foundation, Schmidt Futures, and Google.org. As we launch Talent Finance today and begin advancing its many proposals over the coming months, we welcome anyone and everyone to join us. Throughout the program, we invite you to offer your comments in the chat feature. We really need and value your input as we continue to build out this important initiative. Only together can we reshape our talent pipeline and strengthen our workforce for a more resilient future. Thank you again for joining us. Now let's turn to an interview with Paul Friedman of Guild Education.
Welcome, everyone. My name is Sarah Miller, and I am Senior Advisor with the Federal Reserve Bank of Atlanta and the Center for Workforce and Economic Opportunity. I'm happy to be joined today by Paul Friedman. Paul is the president of the Learning Marketplace at Guild Education. Paul is a longtime advocate for the transformational power of college education. He has founded, managed, and invested in a number of successful education ventures. Paul, welcome to the conversation.
Thank you very much for having me.
As you know, the Talent Finance Initiative recognizes that the new economy requires us to transform how we think about our talent development systems, how we think about them and how we finance them through encouraging public-private collaboration, promoting shared value and risk, and advancing inclusive innovations and expanding choice, which promote equity. I'm curious to get your point of view on this and what trends you think have served as evidence that we need a new social contract when it comes to talent development.
At Guilds, we just believe that the emergence of whatever you want to call it, a knowledge economy, a new economy, just requires a different way of thinking about skills and talent development, and really does require sort of all constituents having a seat at the table. What Guild's business model is about is working with large corporations, Fortune 500 corporations, and administering their investment in their workforce development and their talent. And what we've seen is that there's just a huge return on that investment. And so there's actually a business aligned strategy to invest in talent, but there's also areas where government investment for people who are Pell eligible, for veterans, where that investment can make sense as well. And so we're very aligned with an idea that in a new economy, there needs to be significantly more investment in talent. And that's a situation where all constituents that have an invested interest, the government, employers, and the people themselves should be part of the conversation.
Some would argue that these new challenges that the new economy presents requires more of a robust public role. But we adamantly advocate that we need to make the case for the public-private approach, and that the solution lies in much greater alignment of investment and new tools of action to incent more private investment, both in terms of new training as well as to manage the new risks that will come from these investments. What are your thoughts?
I think that's right. And I think private investment will come where there's a demonstration that there's a return on investment. And I think one of the things that's happened that we've seen of late is that talent development has moved from something that you provide as part of a job description, but you hope that somebody doesn't take up, to something where the smarter employers are recognizing that there's actually a meaningful return on investment. I mean, if you invest in your talent, employees stay longer. If you invest in their talent, you're not investing as much in recruiting new people to fill the roles of the future. Just given the half-life of skills in a modern economy, you can no longer kind of recruit yourself out of a training and development problem. And I think once more employers recognize that, there is less of a need for public investment to make sure that the level of education that society needs happens.
So one of the goals of this initiative is really to build a movement of the ready and the willing, who will do widespread demonstrations of new public-private finance solutions. What do you hope to see out of this movement, and beyond some of the ways that you've already talked about how Guild's position fits in here? How might this transformation generate more demand for services like the ones that Guild offers?
Well, we want to see education investment by employers, leveraging the existing, public financing options. We want to see this be ubiquitous. We think that right now, employers are getting a competitive advantage in the job market by offering, education benefits. They're able to recruit better. They're able to retain better. Their businesses work better. But at some point in time, we hope this is ubiquitous, because once it becomes ubiquitous, then we're talking about a benefit for, American society at large, our competitiveness globally, not just, individual competitive advantages of one company versus another. Where Guild's focus is really the larger employers. We work with Fortune 500 companies. We work with employers over 10,000 or more. I think where we would like to see the activity happening, where we would be a supporter but not a driver, but would help everybody's interest, is the same type of activities that a Walmart is doing with 2.5 million employees, that small businesses, that mid-sized businesses have the same capability of doing that themselves. And that's not where Guild plays, because our technology works with the largest employer systems and is built on expecting enterprise scale. But it's certainly where we would support, as part of a movement, maybe work with other organizations who could leverage our technology to work with smaller businesses, with mid-sized businesses, because we do think that not everybody works with a Fortune 500 company. Most people work with a much smaller business, and so you're talking about something that we hope really has an effect on America at large. We need more than just Guild to be driving force, and we really believe in it, and we'd be here to help make it happen ever we can.
Paul, thank you so much for your time and your leadership, and I look forward to what's next to come.
Well, thank you very much for having me. Really wonderful questions, and big believer in the initiative, and we're here to help in any way we can.
Hello, everyone. Thank you so much for joining us today at the launch of our newest initiative, Talent Finance. I'm Jason Tishko, Vice President at the U.S. Chamber of Commerce Foundation, and I'm joined today by my colleague, Bob Sheets, with George Washington University. Bob Sheets is also a fellow at the Chamber Foundation and is a co-author of the Talent Finance White Paper. We are also, you've heard from Sarah Miller from the Federal Reserve Bank of Atlanta, who is also one of our co-authors. Her colleague, Stuart Andreasen, who you'll get to know later in our event series, also a co-author, and finally, Peter Beard from the Greater Houston Partnership. So as a team, we are excited to bring this new initiative to you. And I'm excited to work with Bob to deliver this opening presentation to orient you all towards the not only the newly released white paper, but to also give you a sense of where we are hoping to take talent finance as a movement. So thank you so much for joining us today. And we're excited to get this started. So there's my colleague, Bob, and we'll be pulling up the slide deck shortly. But we wanted to share with you a little bit of why now and what got us into this space. And as we've been thinking about talent finance as an initiative, as a movement, what we really settled on was the need for a new public-private approach for how we finance and invest in talent. And we need one that is fundamentally fit for our time, not one that was built for the past. And we know that relying on the way we have financed and invested in talent in the past is simply not going to get it done now and into the future. And we've seen the many repercussions of leaning on that approach, whether it's the headlines that talk about 4 out of 10 college students never completing a degree, over half of students who do complete college being unemployed or underemployed in the economy, the $1.6 trillion in student loan debt that students carry, the jumping unemployment rate, the risk of actually earning less should you get reemployed, and of course, the ever-present headline that we see about the number of jobs that are changing or permanently going away. And we know that American families and American workers are facing financial concerns and stress. So we think there is no better time than now to fundamentally revisit how we finance and invest in talent in this country, and how we make it a more public-private solution where we share in the value creation and benefits as well as in the risks of the new economy. If we go to the next slide. We want to share a little bit more with you about kind of the why now. And these are talking points that are taken from the paper that I'll introduce to you in just a minute. But one thing we want to point out is the growing skills gap. This skills gap has been growing now for decades. I like to consider it more of a feature, not a bug, because we have been increasingly separating work and learning for a long time. And we know that has created a great deal of misalignment between the supply side and the demand side, and it's impacting all of us and undermining our economic competitiveness. And we know that it's only going to accelerate. It's not going to get better. It's only going to become more dynamic. The economy will become more dynamic. The labor market will become more dynamic, and skills are going to change and jobs are going to change faster than ever before. While at the same time, we're dealing with the fact that we have growing lead times in terms of the amount of time it takes someone to actually complete an education or training, facing even increasing costs. So it's quite the mix there that we're dealing with. And current initiatives will only go so far in closing this skills gap, because we know even if we improve signaling, if we improve partnerships between employers and education providers, it's only going to go so far to bridge the gap. And what we really need to do now is address the very incentives behind our talent marketplace and understand that by changing the incentives, we will fundamentally transform how we prepare people for jobs in this new economy, but also how they manage risks in the new economy. So we think now is the time to really revisit those incentives for how we manage the investments we make in our workforce and how we manage the risks of the new economy. And we think this is the right group to start it with. So we're hoping to not only introduce this new way of thinking, but to build a movement to really explore this new public-private approach. Next slide. Some other things that we call out in the paper is that it's not just managing the old risks of the previous economy, but it's the new risks of the new economy. And we know these risks are changing, and they're particularly converging on employment and income risks. So folks are facing greater volatility when it comes to just sustaining their employment, but also managing career changes and its impact it has on overall income. And we also know that increasingly in the talent marketplace, data is king. But we need to make sure that we are leveraging new public and private innovation that's occurring around how we can modernize our data infrastructure to better support how we finance talent. We think we can actually give rise to a whole new generation of talent analytics and risk assessment instruments that will better inform us on how we manage our investments now and into the future and get better returns and benefits for our learners and workers. And we also know that this is coming at a time that couldn't be more important, because we need to make sure that as we try to find the talent finance system of the future to enhance our global competitiveness and to expand opportunity, that we will only truly be successful if we address the equity imperative in this country, namely to leverage these new talent finance solutions and instruments in ways that's going to expand opportunity and improve diversity, equity, and inclusion all across the talent marketplace. Next slide. So when we talk about the Talent Finance Initiative, I want you to keep these 4 things in mind. It's not any one of these things, but it's the combination of all of them. Number 1, it starts with the newly released white paper, and I'm going to orient you towards that in just a second. It was just released yesterday. Number 2, it's a 5-part event series with today's kickoff, but there will be 4 additional events, 1 more occurring this week, 2 more next week, and then 1 in mid-October. That's going to kind of lay out the recommendations and various topics and themes that the white paper sets up. Next, from there, we are going to be looking to forge new public-private partnerships in order to fully address and implement the paper's recommendations, which we will introduce you to. And then lastly, it is our goal to not just have a conversation, but to actually move towards action. In all things that the U.S. Chamber of Commerce Foundation does, we are a network of action. So we want to make sure that as we build this movement, we frame the debate the right way, we advance the right set of recommendations that we can get a coalition of the willing around, that by next year, we are moving towards demonstrations and pilots in states and communities all across the country. But we want to make sure that we are supporting a wave of innovation and making sure that we are learning together as a public-private partnership. Next initiative, or next slide. So the paper just came out yesterday. And what this paper does is several things. It introduces a new framework for how we organize the talent finance space. We're going to show you that in just a second, but we want to organize a new way of thinking and how we organize and analyze the various talent finance instruments and innovations that are out there today. It also introduced 9 guiding principles, which I will share with you for how we need to think about how we design new talent finance innovations. It introduces a set of 16 comprehensive recommendations for how we can get started, and it has 27 examples showing you in very concrete ways what we mean by talent finance innovation and how it could be pursued in a public-private way. It concludes with a call to action, because again, this is all about not having a great conversation, it's about actually changing lives. So we want to make sure we are mobilizing this coalition of the willing to leverage these recommendations, these guiding principles, to learn from these examples, and then to proliferate innovation from this point forward. We also have a link here. The slide deck will be shared post-meeting, so you can go and access the paper yourself and take your time walking through the various recommendations and guiding principles therein. Next slide. In terms of a definition, when we refer to talent finance, what we are referring to is the development and use of public and private instruments for aligning investments in talent development and in managing downside employment income risks. It's both and. It's upside opportunity investments in education, training, and credentialing, combined with downside risk mitigation and risk management instruments around employment and income. And we think both coming together, both pursued in a public-private way, is what opens up this space for innovation and for new public-private partnerships to form. But we don't want to just get any kind of innovation going out there. We want to put some guardrails out there, so we've established some guiding principles. I won't go through them comprehensively, but I'll introduce them to you. Number 1, public and private. You've heard that a number of times already, but we need to share in the opportunity and the risk, which is our second one. Shared value, shared benefit creation, but also sharing in the risk of the talent marketplace. So we need public and private, shared value, and shared risk. We also need to expand choice. So as we identify new finance instruments, we want to make sure that they are increasing the career pathway options to learners and workers so they can take their money for the pathway that makes more sense to them, while also expanding choice for employers who will be able to use new talent finance instruments to partner with those they wish to source talent from. Another thing is it's affordable and fair. We want to make sure that these finance innovations are being done in the most affordable way to reach the people who need them most, but also done fairly, so we could eliminate any discriminatory or predatory practices, and we can leverage best practices in truth in lending. Next, data-driven and outcome-based. We want to make sure that new finance innovations are informed by data, actual data based upon the results they achieve, and the outcomes that they're able to attain for learners, workers, as well as employers. We think data is going to be increasingly important, and with a whole new data infrastructure becoming available to us, it could really fundamentally transform how we think about talent finance and investment and how we underwrite those deals. Next, transparent and accountable. We want to make sure that as we are engaging in public-private experimentation, that the lessons learned become available to all, and that anyone who's trying to take advantage of one of these new talent finance instruments or bringing together two different innovations, they are fully equipped with the information they need about what the expected benefits are, the risks they carry, and the kinds of returns they may achieve. And we want to make sure that we treat all talent finance innovations on an equal playing field where there is accountability across the board. Next, empowering workers. We want to make sure that workers are given the access to the financing tools they need to manage their future. So we want to make sure we're giving them data, we're giving them better information about the performance of those instruments, which ones are a better fit for them based on their risk profile, and how they might be able to kind of leverage the latest and greatest that's out there to achieve their dreams. Next, accessible. We want to make sure that these finance innovations are accessible to all workers who wish to benefit from them, but also make sure they're accessible to all businesses. And a lot of the finance innovations that are out there right now are really more accessible to larger companies, but we want to make sure that we are creating a set of finance innovations that could really meet the needs of small to mid-sized business. And then lastly, equity-based. We want to make sure that all the finance innovations we're leveraging are in furtherance of increasing diversity and improving diversity, equity, and inclusion throughout our talent marketplace. We want to make sure that always remains our North Star. Next slide. In terms of the framework, if you go to page 22 of the paper when you get it, you'll be able to go through it yourself. There's a little snapshot there. It's going to be hard to read on the slide, but we encourage you to crack it open in the paper and take a deeper look. But basically, it lays out a new way of mapping the finance ecosystem, particularly when it comes to talent development and financing. And it lays out two different purposes. What are the finance instruments for managing upside opportunity investments, and those for managing downside risk mitigation, as well as employment income risks that currently face workers today. So two different sides of the coin. Next, issuers and financing partners. Who originates the new talent finance instrument, and who can participate as a financing partner, and then who is the ultimate recipient of that investment, and who are some of the other beneficiaries of it as well. So we're trying to map out the full universe of issuers and beneficiaries, and who are the secondary players that may be able to participate in either the investment opportunity or the benefits derived. And then we're trying to identify throughout the framework all the various instruments and channels that are out there for how these investments actually get to the ultimate beneficiary. And there are a lot of them out there. So we're trying to at least map the ecosystem, analyze the ecosystem, and then leverage this as a tool to figure out where are the opportunities to pursue innovation, and where can we start popping together public and private solutions now that we know all the instruments that are out there. But Bob, I'd invite you to make a couple comments here on the framework.
Yeah, Jason, I just want to emphasize what Jason was talking about. It's a public-private framework. You can see that by when we talk about instruments, we're dealing with private sector instruments as well as government tools of action under one framework. So it's public-private on instruments. If you look on issuers and financing partners, we're trying to emphasize that we need to bring more than one financing partner, public and private, together, even when there's a primary issuer on the public or private sector. They need to be coordinated. And we'll go over later is it all has to rest. This ecosystem has to rest on a public-private data and technology infrastructure that allows public-private talent analytics, risk measurement, and the data infrastructure that allows these instruments to work together in a public-private ecosystem.
Great. Go to the next slide. So I'm going to just give you a very high-level profile of the types of recommendations you're going to find in the paper. And then after I kind of run through all of those, I'll ask Bob if you can make a couple quick comments before we get to our call to action. But they're organized in 5 big buckets. The first bucket is what we're asking employers in the private sector to do differently when it comes to how they manage their investments and the kind of leadership that they're displaying throughout the talent marketplace. And we start with what some of the things that employers control, but also trying to assess what's their appetite for doing things differently. So we are going to be embarking on a survey post this event series in partnership with SHRM, where we are going to actually start engaging with members of the business community and the private sector to figure out just kind of what, not only what are they currently doing as far as talent investments, but what is their appetite to pursue some of these new talent finance innovations. So we're going to try to get that touch point, and we're going to share that data with all of you as soon as we have it. Next, we're going to try to promote innovations in how employers manage their financing, both in their talent pipelines as well as with their incumbent workers. And we're going to find new ways to promote employer collaboration, where companies are working together, not just going it alone, but where they can actually promote synergies and employer collaboratives to pursue finance innovations together, not just as one-offs. Next, we want to make sure that We are outfitting these new employer collaboratives where collective action is taking place so they can share in some talent finance innovations to underwrite their shared talent pipeline needs. And we also want to make sure we're promoting new business models for the private sector where they can engage with staffing firms or other types of partnerships that are trying to better direct and sell services directly to companies to help them manage their talent development pipeline, but also how they can manage the ongoing skill development of their current workers and promote them in their careers. Next slide. So we start with what we're asking the employer, or with employers in the private sector, and what we want them to do differently with how they manage their investment, which is significant. But then we're also asking for the public sector to better align with those private sector investments and to better incent them, both for upside opportunity and downside risk management. So we start with ways that employers, or that the public sector, can rethink their roles in tax policy as well as in grant making and making available loan products, and how they could create a more balanced and aligned portfolio with employers so they're constantly incenting more private sector investment in the workforce. Next, we want to make sure that government is also transforming their quality assurance system. So we're expanding choice throughout the talent marketplace and the other types of service providers that could take advantage of these new talent financing solutions. We also want to make sure that we are leveraging government to promote best practices when it comes to truth in lending, and making sure we have the right regulatory framework in place that promotes transparency and accountability for all the new finance instruments that are out there. And then we also want to make sure that government is being very strategic in how it's deploying its assets and resources in ways that will further promoting diversity, equity, and inclusion across the workforce. Next, we want to focus on government policy. So not just where the upside opportunity investments are in education, training, and credentialing, but what are some new and inventive ways we can engage government and public policy on how we can improve a wide variety of employment and income risk management tools. We think there's a lot of room for improvement here. There can be new employment insurance products, income insurance products, and a perfect time to be revisiting what is the unemployment insurance system of the future, and how do we need to modernize that and make it more public-private. Next, we also want to make sure we're revisiting the role of employers in the safety net. And we talk in the paper about different ways employers can engage around things like the earned income tax credit, and could actually be a strategic partner with their workforce in providing them access to more data that informs them of what individuals and families are actually eligible for in terms of safety net investments. Next slide. So if we got the private sector coming in with new and innovative solutions, and we're coupling that with alignment with public policy and government sector products, we now want to talk about what's the enabling infrastructure that's going to support those new innovations so they take hold and scale. But what are all those supports that are needed? We highlight a few. The first group is around talent finance metrics, risk scoring, and HR accounting. We know we need to revisit how we manage HR accounting in this country, and we need to make sure companies are supported in making their investments in their workforce, and that's considered a capital investment and not a cost. So what needs to change on the HR accounting side so companies are incented and rewarded for investing in the workforce and not disincented to do so? Next, we need to be able to explore the risk infrastructure of the future for the talent marketplace. We need new risk identification, measurement, assessment, and scoring products that will better inform the underwriting of a wide variety of talent finance innovations. And we also need to make sure we're establishing public and private data standards for how we report on investments in our workforce. We need to standardize how we're defining these investments and how they're reporting them out, so we get more consistent and high quality data that actually tracks what our investment in the American workforce is. And then lastly, talent finance data and technology infrastructure. We want to make sure that as the new and emerging data infrastructure for the talent marketplace takes hold, that it is being leveraged in ways to tell us more about where learning happens and with what outcomes to actually drive new thinking and innovation in the talent finance space. But we're going to know more about learning than ever before and the kinds of outcomes that can be achieved with that learning. And we need to harness that to deploy better talent finance products and to inform underwriting and a better risk management. So we think there's a huge opportunity not just to create a better learning ecosystem where we're able to share that learning for the purposes of skills-based hiring and learning, but to also leverage it to give people access to better financing products and solutions that are better tailor-made to them based upon the data about them. So we think there's a lot of opportunity here to leverage a wide variety of enabling factors and new infrastructure that's coming up to actually support a whole new renaissance around talent finance. But Bob, briefly, any comments you want to make about the 16 recommendations featured in the report?
No, I just want to highlight, Jason, what you mentioned about the data and technology infrastructure. You really cannot be public-private, guiding principles of public-private, shared risk and benefit, and be data-driven and outcome-based unless you have a truly comprehensive public-private data and technology infrastructure. That is a key requirement of enabling the other recommended actions to take place.
Great. Next and final slide. So we just wanted to give you a high-level preview of what's inside the paper, namely the talent finance framework, the guiding principles, and the recommendations. We encourage you to go and access that paper and kind of read it at your leisure. In the meantime, I want you thinking about two things before I come back to help close out this meeting. The first one is tell us what you are doing. And if you could use the chat box now to do that, that would be great. Let us know what you're engaging in terms of partnerships and innovative practices in the talent finance space, because we want to learn from you and amplify your story. And then secondly, get involved. Participate in upcoming design workshops where we're going to be designing the talent finance solutions of the future and actually bringing together public-private partnerships for demonstrations across the country. Our information is here. You'll have this available to you post-meeting, but we're going to come back to this slide as we do the closeout. But have in the back of your mind as we go through the rest of today's program, what are you doing now that we need to be aware of? And how can you get involved and join this movement and make talent finance your own? We're here for your partnership. That's the point of this event series. We want to get to know you. We want to pursue this movement with you. So with that, we are going to move to the next part of our program, and we are going to hear an interview with Aaron Robert from Jpmorgan Chase.
Well, hello, everyone. I'm Carolyn Cawley, and I'm president of the U.S. Chamber of Commerce Foundation. I'm so pleased to be joined today by Erin Robert. She's the head of Impact Finance at Jpmorgan Chase. And Erin, I just want to thank you and Jpmorgan Chase for your partnership over the years, and in particular, your support for this new initiative that we're calling Talent Finance. You've been such a recognized leader in the field, and we're just pleased to be doing this important work together.
We're so excited to partner with the U.S. Chamber of Commerce Foundation on this exciting initiative. This is an issue that's so important as we think about the broader development of the market, how we think about labor participation and ensuring that workers are prepared for the jobs, frankly, that will exist in the future.
You know, coming at this as we both do from a business perspective, it's always helpful to have a framework around which to organize our thinking and our actions, particularly in this talent finance ecosystem. You know, you've been in this field for a long time. How useful is the talent finance framework for you? And does it help you, see new opportunities for innovation in these new ways of thinking?
So I found the framework particularly helpful when we see, frankly, the collision of the investment community approaching a new topic in the environmental, social, and governance space. Oftentimes, it just requires some level setting and understanding. And investors are really good at teasing out where inefficiencies in markets exist. And I thought the framework did a great job of identifying where some of these inflection points are and where some of the gaps in coverage might exist. And that really helps new entrants to the space develop a fluency in what may be a new area for them. I mean, I think talent finance is, it's a new horizon for many investors, and giving them a language and a vocabulary to understand how it's been done to date is exceptionally helpful.
Indeed. You know, throughout the work that we've done on this talent finance initiative, we've really relied on some core guiding principles about innovations in talent finance. And, key to those principles, we've talked about this a lot together, is that the financial instruments should be both public and private, and they should create shared risk and shared value. And that's the way that these new financial instruments can expand choice and create new opportunities and empower workers and employees who in turn will enrich their communities. What stood out to you about these guiding principles? Are they consistent with how Jpmorgan Chase is already looking at its investment strategies and tools?
Absolutely. And there were three in particular that stood out. The first was, to your point, bringing together public and private institutions. That's a theme in the financial services that crosses many sectors, whether it's infrastructure. It's something that we see as a common theme where, frankly, you have the collision of the public and private markets, where there is shared value in public goods and investing in things that are public goods. The second is diversity and equity. It is a lens, frankly, that many investors are now really bringing into their investment selection process And we're happy to say many investors are becoming more fluent in. It's no longer limited to impact investors. Traditional institutional capital is now really bringing in an equity and inclusion lens. And then finally, this approach is data driven. That is the bread and butter of the investor community. Understanding inputs and outputs and being able to track the impact that a dollar is having is also critical. And here we know that we're solving for results. We're solving for programs that actually create a skill set that is marketable and that is monetizable by the public and private sector. And that is music to investors' ears.
At the Chamber Foundation and in our Talent Finance Initiative, we've really emphasized that employers have a tremendous stake when it comes to investing in workforce development before they become workers. And estimates range anywhere from $200 billion to $400 billion annually, including $60 billion in tuition reimbursement. And we think, like many people, there's just got to be a better way, and there can be new tools that come from the financial services sector. In particular, I'm so intrigued by income share agreements, or ISAs, and investing in portable lifelong learning accounts. Those are getting some real validators and some real experimenters. And I wonder if you could talk a little bit about JPMC's view on these as new financial instruments.
Yeah, it's a great question. We're so excited to see the innovation in the market. Really, as we think through what are alternative mechanisms where employers can frankly start to participate in these. I think the spend detail that you provided indicates what an important investment, it essentially spending capital in their workforce is. And I think that really underscores the value to the private sector. You can always follow the money with the private sector. They will spend money where it's important to do so. As we think about innovations and different ways that they can provide these benefits to employees, I think it's striking a balance and ensuring that we don't jeopardize employee choice and the ability of employees to move freely in the labor force, so that we don't create unintended consequences through these financial instruments. And I think what's interesting about income share agreements is frankly the implicit cap on the amount of debt that the employee is going to be paying, based on their ability to do so. And that, I think, is a very interesting premise that actually borrows from some other markets. It's actually pretty traditional in the oil and gas sector to see royalty streams associated with underlying production. And so I think we can really work to take the best elements of existing financial structures without creating the negative externalities that may result.
Thank you so much for your partnership on this really important work. It's been really nice talking to you. Thank you, Erin.
Likewise, Carolyn, and thank you again. We're thrilled to be partnering with the Chamber on this important initiative.
Well, thank you so much to Carolyn and Erin for a really interesting interview. It was great to hear from one of our talent finance partners to start to understand how financial institutions are thinking about these really pressing issues. I'm delighted now to turn to a real all-star panel, both in life and in particular for this topic. And so let me introduce you quickly to Sheila Bair, who is the director of the Volcker Alliance and former chair of the FDIC. Thank you so much for being here.
Happy to be here.
Next up, and I guess I should say quickly, I think that your reputation speaks for itself, but you are clearly widely known and considered quite an expert, of course, in the financial services industry, but people may not be as familiar with you in this space, and that you have been writing papers and thinking about emerging talent finance innovations, and also as a champion of income share agreements. So we're looking forward to diving in there. Next up, we have the former governor of Delaware, Jack Markell. Governor Markell has, of course, really unique public policy experience, as you might imagine, being a former governor. But he too should be better known in this space, I think, as he has really been thinking about what public-private partnerships look like here, how you find new talent finance solutions for learners and, of course, workers. And he has been a leading proponent of the lifelong learning credit, which, as you're going to hear in a minute, I think is a really important tool as we start to think about moving away from the focus on four-year degrees. And last but certainly not least, we have with us Scott Pulsifer, who's the president of Western Governors University. You know, I've been reading a lot about you. WGU is a really cool place. It's been recognized by Fast Company as one of the 50 most innovative companies. And Scott is a very vocal champion for how higher education has to play its part in this conversation, in this debate, and think about how it has to fundamentally transform its mission to align both with business's needs, but also to support its students if it's going to be competitive in the new economy. So first of all, thank you for your partnership on this initiative, all three of you, but also for joining us here today. And so I want to start, Sheila, with you.
Okay.
So we heard Jason a minute ago outline the talent finance paper and the topics it looks at, and it makes the case that the financial services sector can help by bringing new thinking into how we finance education. And so as you, from your vantage point, think about that, what do you think the lessons or best practices are that can help us reimagine this topic?
Yeah, so I think just some basics and then some reimagination. So the student debt system that we use now just isn't working. It's really broken. It hurts young people. It's hurting their futures. And I think, you know, just basic best practices that you would apply in the private sector, in the private financial sector, like disclosure of key loan terms, what the repayment will have to be, basic underwriting. Don't make a loan unless you're sure the borrower can repay the loan. None of those really apply to our current student debt financing system, which is one of the reasons why it is serving us so badly. And I could go into the whole parade of horribles about, you know, there's no statute of limitations, no discharge and bankruptcy. It's kind of as a bank regulator, I think if a bank was doing some of the things that our own government does, I would not want to be seeing that. So I think just in terms of basic back practices, to the extent we stick with lending, that we should at least apply to government loans the same standards that any regulated bank would have to adhere to. But going beyond that, to the innovation piece of this, debt really is a bad way to finance higher ed, especially for young people, because you just don't really know what their repayment capacity is going to be. It could turn out on, you know, the quality of whether do they complete their degree, the quality of their degree, what the job market looks like when they graduate. There's so many different unknowns. To try to use debt, which is fixed and static and inflexible, is really not a very good way to go. So income share agreements shift you into an equity model. And I was so glad to hear the earlier favorable comments about it, because you just get rid of debt. Don't have principal, don't have interest, don't you have negative amortization where your loan balance is actually getting bigger, which is another facet of our student loan program, because you can't afford payments to cover your interest. Get rid of all of that. It's simply a contract between the entity financing the education and the student to pay a certain affordable percentage of income above a certain threshold, subject to a cap, over some period of years. And what I like about a lot of the private sector initiatives here is that the hurdle rate, the minimum income you actually have to earn before you start repaying, suggests, you know, it's to 40, I've seen as high as 60,000. So your obligation to start repaying doesn't even kick in until you've really achieved a premium from that college degree or whatever type of educational degree we may be talking about. And I agree, we need to think certainly more broadly than the standard four-year education. And it also nicely aligns the incentives of the entity providing the financing with the student, because you're both invested in that student's success. You only succeed if the student succeeds. And I really am enthusiastic about employers doing that, because then you have a perfect alignment of incentives, because the employer really will not be looking for a financial return on that ISA so much as a great employee, a great well-trained employee that's going to fulfill a labor need that they have. So I celebrate the chamber in your paper for highlighting this ISAs generally and employers as a source of partnership and funding in particular, because I really think it's a nice alignment of incentives to make sure kids get the best quality education possible, something that's going to get them a job and an affordable payment. And that would be a huge improvement over what we have now.
Yeah, definitely. And I have another question I want to ask you, but first let me bring the governor into this conversation, because I thought you did an interesting run there on kind of how we finance education, which is, of course, a really important piece of this. But Governor, let me ask you, the other half of it is how the labor market is changing, right? And how, as Sheila was just talking about, businesses and their role as kind of the consumer, you didn't use that word, that's my word, but kind of on the other end. So Governor, how do you think business and labor markets are changing that also make this an important debate to be having right now?
Well, thanks. And let me start by thanking the Chamber for doing this work. And I totally endorse what Sheila just had to say. I saw this every day when I was in office, because pretty much every day in office, particularly from around 2011 on, I had the same two conversations every day. I would speak with employers who told me that they couldn't find enough skilled employees. And I talked with aspiring workers who just wanted a chance to work. Maybe they were people who had been incarcerated. Maybe they were people who didn't have a great experience in K-12. Maybe they were just underskilled for some other reason. And so a big part of my job was figuring out how to bring these people together, because what happened as a result of that, so often employers would tell me, when I asked them what their recruitment strategy was, they would tell me that their recruitment strategy was to hire away from each other, which is a lousy recruitment strategy. It just doesn't, I mean, it really does not work. It certainly doesn't work for society at large. So when you combine that with the fact that there really are not too many commodity type jobs out there any longer. Years ago, if you talk to folks who follow the credit card industry, observers might say, well, they're all competing based on, the interest rate, or chemical companies might, sort of outside observers might think they're all producing the same kind of products. But the truth is, these days, everybody is focused on talent, because the only way that you're going to succeed is either you have a better product, you have a better distribution channel, and it's tough to figure these kinds of things out. So when you're recruiting for talent, you need to make sure there's a broad pipeline of new folks available, so you're not just hiring away from each other. So I think that is one important area of conversation. And the other is that we have better information on the labor market today than we have ever had before. I mean, it is astounding. There are a number of businesses out there that provide access to labor market information for example, universities and colleges who are figuring out what kinds of programs they should offer, for businesses that are trying to figure out where to locate. And the data is now so granular that they can say, okay, we need Java programmers. Well, there are 300 in this market that are available, but there are 700 in this market. So it really helps employers make decisions about where they're going to locate. So there are so many changes going on, which frankly can be for the better. And the question is whether or not they will be for the better. So a big part of where the government steps in is whether we do a good job convening the employers with the K-12 system, with the higher ed institutions, and whether folks are really listening to each other.
I want to follow up with you in a minute on your government comment, but first let me bring Scott into the conversation and ask you this question. If Sheila talked for a minute about finance and the government talked for a minute about the governor talked for a minute about the labor market and the business angle, talk to us about education itself. I mean, I think we've seen this pandemic just accelerate trends in the way that people are learning, the way that people are accessing education. But what are you seeing as these trends and how that fits into this conversation?
Yeah, thank you for that question, Susanna. It's also great to be here, and Sheila and Governor, also great to be with you as well. One thing I think I would generally say is it's great to be part of this conversation, because what we really are talking about is the talent supply chain. And the reason that these things are connected, it is that education has long been and will continue to be the surest path to opportunity. However, we have a fundamental design problem, which is we are basically talking about finance often in the context of a one and done model of post-secondary education, that somehow you pursue a degree and you do it only once in your life and you never pursue additional learning to lead to the next opportunity. When I think what we're really realizing is what the governor was highlighting, also Sheila was hinting at, was that the future is much more of a lifelong learning loop, a mechanism by which to keep up with the rapid pace of change in the workforce and how quickly the skills that we may have gained the first time are becoming outdated simply because things are changing so rapidly that the shelf life of our skills is declining. It actually means that we are going to have to be acquiring additional learning, even in the form of certifications and credentials, but even just straight skills. That says that learning loop is a model that we see going on in the future. And we have a finance model, or for that matter, an accreditation model and regulatory model, everything else built around a post-secondary model that says, oh, you go to college once and then on your merry way for the rest of your life. We even think of like an attribution window of value for like, oh, 30 or 40 years later, sure enough, that education paid off. But in reality, where education is going is we see it has to be much more connected to the future of work. We have to recognize that there need to be pathways by which not just first-time students, but also working adults and those who need to pursue the next opportunity, that they have an education pathway that makes that possible. And so we'll see the emergence of more shorter duration credential pathways. We'll see, an increasing percent. Heck, we're already at 40% of all students enrolled in post-secondary over the age of 24. That percent is only going to go up. I wouldn't be surprised within 10 years that the majority of those enrolled in post-secondary will be over the age of 24. And so we have to be thinking about the models, not just from finance, but regulatory and otherwise, that allows that learning loop to occur in the future.
So later, one of you can be the one who volunteers to tell my teenager that it doesn't end after a certain date, that she's got to do this in perpetuity. I'll pay handsomely for somebody else to deliver that message. But while you have the microphone, let me ask you a question here. The paper got into not just the kind of innovations, but also the infrastructure, right, that was going to be required if we were going to move in this direction. And so were there examples either in the paper or in life that stand out to you as the most compelling recommendations?
Yeah, there are quite a few, and I think maybe let me just hit on two. One is simply the notion that you need to actually have the idea of a lifelong learning model factored into the financing model too. I would agree with what Sheila highlighted in the first place. Debt is seldom a good financing vehicle for something for which you don't really understand the value of the asset being acquired or being financed. And in many ways, we're talking about financing a pathway or the opportunity, the pathway that leads to, but that is unclear. But what we do know is that we have to think about this, the lifelong learning model, and that we have multiple different options in that. So one of the other things is, just as a principle, the notion of expanded choice, that it isn't only about the degree. And so the contemplation here in the paper is specifically recognizing that it can be apprenticeships, it can be short form credentials. We even at WGU offer medical assistant programs and medical coder programs. Like, these aren't degree programs that are automatically federal aid eligible, and yet they're high value, outcomes driven, learning pathways that are not currently contemplated in finance. The other idea is simply that it is not a one and done model. This notion of the lifelong learning account is a wonderful idea, similar to healthcare savings accounts, similar in a way that it allows the individual, even the government, whether it's federal or state, and employers, to all contribute to effectively a learning account that allows the individual to leverage that financing for not just the first learning pathway, but also the second one. And when you combine that with the choice to where I could apply it to apprenticeships or certifications or a degree, like, that allows this level of flexibility that we just don't have today. The second thing I would just simply highlight is the data-driven approach and the transparency that needs to exist around this. Is that if we're going to expand the choice and think about lifelong, we need to know that actually those things are being financed result in outcomes, for not just the student or the individual, but also for the workforce, also for employers, et cetera. There has to be a degree of data that supports the tracking and the impact on the student or on the learner outcomes, so that we know that those pathways are actually working, that they're being prepared and readied for the future workforce that's needed by employers, that those employers are actually hiring these individuals, that there's a return and the repayment of the financing. That depends on a data and a transparency model that was articulated well in the paper as well.
And I think really important. I remember getting my MBA and having a professor say to another student, you're not the customer, you are a stakeholder, but there are a lot of stakeholders. There are alumni and professors and researchers and eventual employers who are all stakeholders in what the value of this degree is. And it was really eye-opening to start to think about that. Governor, I am coming back to you about the government role in just a minute, but Sheila, let me ask you first. The Chamber announced some work over the summer on equality of opportunity. What could we do to get into different communities and really create a more equitable playing field, particularly for people of color? As you look at different ways to finance education and training, do you see that as a way to create more equitable education opportunities?
I absolutely do. I mean, again, an equity model, an income share model, that's about your future. It's not about your past. If you come from a lower income family, if you've been historically discriminated against, those are extra obstacles that you carry with you. But the ISA is all about your future and making that future have better opportunities for that future. So I absolutely think, again, it takes the risk off the student. The burden is calibrated directly towards their success in the labor force once they get that degree of certification or whatever the training might be. And I back to Scott's point about having a financing mechanism or as well as an infrastructure that produces results, that we have a data-driven approach with metrics so we know we're succeeding. ISAs and how they perform can be one element of that because they are a reflection. The ability to make repayment on an ISA is a reflection of how successful the student or trainee has been in the workforce. So yes, it's about making futures better, not driven by, it doesn't qualify you based on the income level of your family and you get a better deal if you've got rich parents who can co-sign for your loans. You don't have to do any of that. It's all about your future, making your future better. So absolutely, I think it's a great way to expand opportunity without burdening financial futures, but improving them.
I love that sentence, that it's about your future, not about your past, which isn't that what education and opportunity should all be about, right?
Absolutely.
I love that. So Governor, some people look at a challenge this big and they say, oh my goodness, so education's really broken in this country. It has the equity issues we just discussed. It has outdated metrics. We're not tracking enough, et cetera, et cetera. What we need is more government involvement. Like the government really needs to step in and fix this. And yet you see in this paper that we're looking more at a public-private partnership, at both sides coming together kind of to do more. And so my question to you is, what do you think the balance is there? When you think of a public-private partnership that steps into this space, what opportunities do you think that unlocks?
Let me first say, if every institution was like Western governors, then government would not be as necessary as it is. And the reason I say that, and it really relates to something that you said earlier about, who's the consumer here? We have such a massive disconnect in this country in the following way. When you ask university administrators, for the most part, I'm not talking about places like Western governors, but if you ask most university administrators if they're doing a good job preparing their students for the workforce, something like, I don't know the exact number, but something like 90% of them say that their institutions are doing a good job preparing their students for the workforce. And then if you ask employers whether universities are doing a good job preparing students for the workforce, about 10% of employers think so. I mean, that is not sustainable, particularly when so many families are borrowing so much money to go into a job that ends up not paying anything. Is it a wonder that people are so unhappy? And I'm on the board of an organization called Strata Education, which a few years ago did a big partnership with Gallup. And they interviewed over 300,000 people about their higher education experience. And for the most part, the responses were really pretty bad. because I think so many people feel like their education after high school did not really help lead to anything that they wanted it to lead to. So that's a problem. So the answer is certainly not that government can fix everything, but I do think this idea of the kind of partnership you're talking about is important. So for example, one of the most important things that government can do is it can convene. I mean, it really is unbelievable how rarely the employers and the educators, whether it's K-12 or whether it's high ed, actually listen to each other and understand, and how rare it is for the employers to say, these are the skills we're looking for. We want to work with you to make sure that your teachers understand the kinds of curricular materials, the kind of equipment that students should be trained on. And if we make that happen, it's going to be a huge success. And sort of one small example, people don't think of Delaware as a major area for employment related to airframes and power plants for aircraft. But we have probably 1,000 people in that industry in our state. And I kept hearing over and over again from the employers who would say, we can't find enough skilled people. So I brought the employers together with the K-12 system, with our community college. The community college kicked in some more money, the state kicked in some more money, and we doubled the size of the program. Still not big enough, but at least it was a step in the right direction. So I do think there is a role to play where government can partner with. It's a multi-leg stool, because it's the employers, it's the training providers after high school, including universities, including other 4 years, including 2 years, including other training providers. It's the government, and it's really everybody working together. You can make real progress if you do that, but it has to be done.
It's such an important point, and I think part of the success of the Foundation's Talent Pipeline program has been exactly that in the communities where it operates. And so thinking about how that gets expanded into this space is an important part, I think, of this work. But it makes me want to ask you, Scott, what other partners are needed at the table? If we think about this event as part of the goal is to figure out, as we think about talent finance, who do we need to bring to the table? What pops into your head? Who are the partners in this endeavor?
Yeah, I think at the end of the day, the agreement, I think, around the promise of education exists between an institution and an individual. And I'd love to start there, because I'd like to come back to something you said and the experience you had. Is one thing that at WGU we're entirely clear about is that we exist to serve the student, the individual. Because if education is to be the surest path to opportunity, then that promise has to be real for every individual. And that focus on the student, first and foremost, ensures that institutions are measuring their impact, even the quality of what they do, on things like student progress, student persistence, student completion, opportunity attainment, economic return, engagement rates, a lot of the things that the governor talked about in terms of the Gallup surveys also identify like the outcomes of education and how well are institutions producing those outcomes for individuals. But I think if we start with the student at the center of everything, you'll start to identify the other stakeholders or partners. Surely employers and workforce are part of that. We also know that will increase as you start to see the, I wouldn't call the unbundling, but the lifelong learning that's going to occur, because employers are having to invest in readiness and enablement, not just for the first job, but also for the next job and the next opportunity. And you can see this, how Amazon is investing with the Amazon Choice program, and how they're investing $700 million to retrain 100,000 individuals, really upskill and reskill individuals from fulfillment center and customer support roles to development jobs to corporate jobs. Like, we know that life is a ladder, and so employers want their individuals to be progressing and developing up their ladder. So employers are surely a partner. I would say regulatory and accreditation is also a partner, because they also have to think about their influencing eligibility criteria for federal and state programs of aid. So we have to be thinking about what really are the conditions or criteria by which financing can be a part of the talent supply chain and enabling a rich environment for innovation that will lead to the promise of education working for more. I think that also brings in the federal government itself and federal student aid, that we need to create an environment that contemplates that first and next opportunity model. One of the ways in which you can see the partners come to bear would be something like the lifelong learning account, because if it's in the individual's name and they can contribute to it the same way they're contributing to a 529 right now, but you also broaden the number of eligible pathways and programs, but you also then have employers that can contribute to it and match it just the way we contribute to a health savings account. You could, as a federal government, say every person that's born is going to immediately get $5,000 in that account that can be invested. As you complete your next program, you'll earn another $2,500. You can have these ways by which different parties can contribute to a learning account that the individual at the end of the day is participating or leveraging to use to fund their learning. So those are some of the parties. Maybe I'll end where I started, which is the student also plays a role too. I think one of the things that Sheila's highlighted around income share agreements or future focused financing is there are ways to also design financing options that increases the incentives or promotes completion and rewards them for progressing at the right pace, reducing the cost of acquiring the credential they came to get, et cetera. That, if you contemplate 150% of time eligibility criteria, like, wait, where else would you do that to where you'd fund 150% of the value? Like, if it should only take you 4 years, like, why should we be funding more than that? And you want to have incentives and ways by which you also promote accountability from the student, that they actually do progress, they do complete, they do seek the opportunities, because we want the financing to be perpetual and self-sustaining. So the student has a role too.
That's really interesting that, why are we funding 150% of this, right? I think and what are the incentives to finish on time? That's really interesting. Sheila, let me come back to you for a second. If there are people in the audience for whom talent finance is a new topic, or as we bring this to the street a little bit more, right, how would you explain to people, how much money we already spend on this system and how this might be smarter money into the system as opposed to simply more, good money after bad? So how would you describe this to a novice?
Well, I do think an equity-based model will bring a lot more discipline and accountability and aligned incentives for all the different stakeholders, the funders, the students, the colleges themselves, because again, there will be no return on the initial investment if the student doesn't succeed. That's the beauty of it. Whereas with debt now, a college, and there have been a lot of abuses with the student debt program, both for-profits and nonprofits, low completion rates, poor quality degrees. There's really no accountability. The proceeds of the debt go to the educational institution, but they don't really suffer ramifications if the student does not succeed. So it's just the way the thing is designed is to encourage waste and rent seeking. And frankly, that's what we've gotten now. So no, I think we would get a tremendous amount of efficiency with an equity-based model. But I also wholeheartedly agree with the governor and Scott in terms of how we need to think more broadly about the kind of training we subsidize, think more about employer partnerships. I think this pandemic is just reinforcing a lot of trends we were seeing already, with a need for very dynamic and fluid labor force. The PPP program, it had its problems, but at least that was a structure that actually subsidized businesses to retain through grants, not through loans, through forgivable loans, to keep people on payroll. I can see expanding that concept also help with retraining cost when you do have economic upheavals and labor market shifts. That would really be a positive way for government to partner with those who provide training and employers themselves. So we would get a lot more bang for our buck if we got smarter about the kinds of education and retraining we provided, and then use an equity, not a debt model to do it.
So, Governor, if I ask Sheila to address people in the audience who might be thinking of the business angle of this in a new way, what about you? If you had a message to anybody in the audience who's thinking about it from a government perspective or a labor force perspective, what would your message be?
I think the first message would be, let's make sure that all of the parties in this are taking advantage of the much better information that exists today than has ever existed before. One of the challenges for so many high school students across the country we just don't have nearly enough guidance counselors in our schools. The ratio of guidance counselors, of students to guidance counselor in many schools is like 400 to 1. And so it's really difficult for them to get time with people who may be in a position to give them good advice. But thanks to companies like MC, which is owned by Strata that I'm on the board of, or Burning Glass or others, we just have so much amazing information about here where the jobs are, here what the jobs pay, here are the skills that you need to demonstrate in order to get the job. Here's where you can get those skills, and here's how much you're going to have to pay for them. And here's what the career ladder looks like if you start down this path. This is amazingly helpful information to have. And when you combine it with the kind of discussion about the ISAs, it just puts people in a position to make much better decisions. And so, to Scott's point, I find myself in violent agreement with everything that both of my colleagues have said on this call, which probably doesn't make it so interesting for those who are looking for a debate. But, Scott's premise that education is really an understanding and a commitment and an agreement between an institution and a student. We want to put the students in the best possible position to make smart choices about what they're going to study, where they're going to study, how much they're going to pay for it, what's it likely to lead to. And that information exists. And I think, so my advice to the members of the audience is to really educate yourself about these new tools and figure out how we can get that great advice, that great information to students, education providers, employers, and the like.
And how about you, Scott? What would your last word be to this audience of people who I think are here because they're at least intrigued, if not committed, to moving these concepts forward? What's your takeaway for them?
I think to reiterate this promise of education as the surest path to opportunity. It is something that we have to make work for everyone, regardless of whether they're on that first rung or on the next rung on the ladder of progress that they expect in their life. And I think we kind of live by probably two simple things. One is the inherent worth of every individual, and that if given the opportunity, everyone has something big to contribute. The second is simply a realistic view of things, which is if talent is universal and opportunity is in fact abundant, what we're trying to solve for is the gap or the bridge between that universal talent and abundant opportunities. Like, because those bridges and pathways aren't equally distributed, nor are they driving equitable outcomes. And so we shouldn't assume that a one-size-fits-all way of financing it or affording it or removing the barriers that already limit access to those pathways. We shouldn't assume that a one-size-fits-all model of talent finance is going to work either. We should be thinking about, all right, what are all those different pathways? How do individuals traverse in that? What are the employers and the workforce role in that? How do we make sure it's adaptable and ready for the future of where it's going? Like, that is the thing that we need to be taking away, is that we need to constantly be innovating for the future. I would probably end with kind of reemphasizing what Sheila's brought really to bear on this, which is an equity-based approach to this, in the sense of it's about a future, not about something that's pre-existing or the past. So when we're contemplating about how financing can enable a future, there are more fair and equitable and even risk-adjusted ways by which that can work, whether it's an individual's first credential and degree or whether it's their second one or their third one, et cetera. And that to me seems like it's going to drive the amount of workforce enablement, access and equitable outcomes, like everything that we want in terms of enabling education as the surest path to opportunity. There are ways by which we can even drive that innovation talent finance to make that future a reality.
Well, look, I think the governor's right that one way to have an interesting panel is to have controversy, but another way to have an interesting panel is to be talking about a really exciting and important topic. And so here's something that's been on all of our minds. It debated at dinner tables all across the country for how long? And I think we're getting to a place of speed and action. And so I think this has been really exciting. I can't thank the three of you enough for taking time to help us with this project and be with us here today. And I would just challenge, I guess if I were looking at the audience and saying something, it would be, please come along with us. Speed is going to matter here. Keeping up with the pace of change and getting to action quickly is going to matter. And that's going to mean bringing new people around to this conversation. So I want to thank all three of you very much for being with us on this journey and leading pieces of it in your own professional lives. I want to thank all of the participants and audience members who joined us today. We can't wait to hear from you. And as I said, bring speed to this change. And I just want to take a personal point of privilege and thank the Center for Education and Workforce within the Chamber Foundation for such important and great work. Both Cheryl Oldham and Jason have done a remarkable job. I'm so proud to be your colleague. So with that, let me turn it back over to Jason to close us out. Thanks, everyone.
Bye-bye.
Thank you.
Hello again. Thank you for joining us for this kickoff event. We did have a few closing remarks we wanted to share with you before we bring to a close this first forum. The first thing is we did get some questions that came up in the chat box along the way, and one that came out that I thought it would be best to address before we close today was how this initiative, Talent Finance, relates to some of the other workforce initiatives that are being pursued by the U.S. Chamber Foundation. Many of you on this phone today are either familiar with or are part of our Talent Pipeline Management Movement, or TPM. That is our supply chain approach to how we build talent pipelines. And as we've been building out these employer-led networks all across the country in 33 states and Canada, we have been getting employers to engage in authentic collective action to organize their workforce information and needs, and to broker preferred provider partnerships to actually build performance-based talent supply chains. We now have hundreds of active employer collaboratives involving thousands of employers. And what we are excited about is with this new initiative, Talent Finance, we can go back to those employers and employer collaboratives who are part of those talent supply chains and equip them with new training and new talent finance instruments. So that one of the things they can co-design is how they plan to finance and underwrite their talent development needs. So no longer somebody else's problem, employers can actually play a very proactive role and engage in collective action and joint procurement and purchasing of new talent finance solutions. Imagine, if you will, if we had dozens, if not hundreds, of our TPM employer collaboratives pooling their investment together, being matched with public and private investment to create their own standalone income share agreement accounts or career impact bonds. And if they were to do that, they would have a direct equity stake in their future workforce. And even if there were elements of poaching or individuals were to move on to a company outside of that collaborative or to another state, companies would be able to mitigate their risk by still drawing down some benefit from the equity stake they have in that workforce. So there's lots of ways to think about how to leverage our TPM movement to actually become the test beds for new talent finance solutions, not pursued by any one company, but by collaboratives of companies who can share in a talent finance solution. Other things we can talk about that were profiled, something that Scott mentioned that really resonated with me is it's not about finding a one-size-fits-all approach, but this talent finance movement is all about coming up with a new framework for mapping and analyzing all the various innovations that are out there and combining them in new and inventive ways to get different results. And whether it's something like income share agreements or career impact bonds, outcomes-based financing, or lifelong learning accounts, which can fundamentally change how employers put direct investment in their workers and give them choice for how they want to pursue lifelong learning and skill development. Ways that could be pursued as a public-private solution with private sector dollars matching public contributions, so on and so forth. We also talked about the various risks of the new economy that need to be imagined. And now is a great time to talk about how we might be able to modernize our unemployment insurance system in this country, but perhaps pursue a more public-private solution where the private sector products and new income insurance products could be made available to supplement our UI system. And another feature that's been discussed is the data infrastructure, as well as the need to fundamentally revisit how we manage risk in this country. Think of the opportunity there is to really leverage this conversation to advance a more equitable talent marketplace. For so long, we've tried to treat everyone as the same when it came to the types of talent finance solutions that were available to them in order to promote open access. But in so doing, we never truly reckoned with measured, assessed, or scored the risks an individual may face for the pathway they've chosen in the finance instrument that's underwriting it. And now I think we can leverage best practices from the financial services sector to rethink how we can actually manage a scoring of that risk. Much like we have FICO scores, we could have talent opportunity scores. And these scores could be used in order to better target incentives and subsidies that could help mitigate, manage, or reduce or eliminate that risk that individuals face. So we think there's some powerful new tools that could be developed here. And it's not just about any one, it's not just about ISAs, but it's about a whole universe of tools that can be explored in a new public-private way, including ISAs, where we can experiment together and learn together as a network. So I wanted to make sure folks understood where some of these talent innovations can actually marry up with the work that we're doing around talent supply chains. In addition, many of you are either familiar with or are part of our work around the Job Data Exchange and the T3 Innovation Network. And I want to make sure you understand the connection between the emerging data and technology infrastructure we're talking about here and the kinds of powerful data that can come from that public-private data infrastructure that can now inform and transform how we manage talent, finance, and investments. We're going to know more about learning and the outcomes it achieves than ever before in our history, and how we choose to leverage that to inform how we actually manage investments and financing products is a real opportunity that should not pass us by. So as we're building that and we want to support a better and more robust learning infrastructure, we also want to leverage it to advance new and innovative thinking that's going to give better products and services to learners and workers when it comes to how they finance and underwrite their own talent development needs and pathways. So I want to make sure we were drawing connections there. These things are very much related to one another within our portfolio. We heard a lot about different financial innovations. We're going to be hearing about a lot more. We have a lot of other forums planned for you that's going to dive even deeper into some of the topics and themes and recommendations in the paper. Today's goal was to kind of give you the broad swaths of all the topics that the paper had teed up, but what we hope this movement is all about and the work that we hope to accomplish together. If we could pull up the slide deck, I wanted to revisit that call to action slide and remind you that we have two asks of you, whether or not you've been able to address that in the chat box today or want to follow up in a conversation afterwards or in future forums that are coming up. We want you to tell us what you're doing. Talent finance is all about creating a movement. It's an umbrella initiative to map the talent finance ecosystem and to learn how we can make it more public and private, as well as consistent with all the guiding principles that we shared earlier with you. And a lot of you have already gotten to work on this. So we do not want to reinvent the wheel. We want to know what you're doing. We want to learn from what you're doing. We want to share what you're doing. So get us in the know, and we will do our best to make our movement your movement. And then secondly, we want you to get involved. Don't sit on the sidelines. This is just too important a time right now to let this pass us by. We have to have this difficult conversation, but it's one that can bring tremendous opportunity. So we're going to take on the hard issues. We're going to talk about not just one thing that needs to change, but many things that need to change. Quality assurance, data infrastructure, HR accounting practices, building a new risk infrastructure for the talent marketplace, and then creating space for a wide variety of innovations to take hold and scale. It's a monumentous task in front of us, but we think the kind of public-private collaboration that can emerge from an initiative like this can get the job done. We certainly are committed to doing it. We hope you can commit to do it with us. So I mentioned a number of the folks who are represented on your screen here with their contact information, who have been contributing as co-authors to the paper that was released yesterday. But I also do want to call out a couple additional folks, namely Jane Oates from the Working Nation team, who's been helping us on the communications front and supporting all the various material that's been part of our communications drumbeat that we'll be sharing. We hope you like some of the pre-recorded interviews we've done. You're going to be seeing them throughout the event series and much more. And we'll be hosting that content on our website in a new digital magazine that we'll share later with you at the end of this event series. And I also wanted to recognize Sarah Castro and Chief Etheridge from the Chamber Foundation team. Without their efforts, we would not be where we are today. So they've been valuable members of the team in bringing this initiative to you. The last thing I want to just talk about is why we want you to join us. This is the moment for our time. And we think this is the conversation we've been building towards in our work over the past 7 years. And we really want to do this with you. This is not something we want to sit on the sidelines for, but this is your opportunity to really co-create the future. We've done it the old way. Now is the time to do it the new way, but you need to co-create that future with us. And just to give you a taste of what that looks like, if there's one thing you look at in the paper, as much as I'd love you to read the whole thing cover to cover, if you go to the call to action, we have a little snapshot in there that gives you kind of a current state, future state walkthrough about the life of Robert and the life of Sarah. Robert, who's kind of going through it the current way we do it, and the kinds of risks he experiences in the new economy and the kinds of steps back he has to take in life, in large part because of the financing solutions that were available to him and where they worked, but also where they didn't work. And then we talk about Sarah, who's leveraging the new talent finance infrastructure of the future per the recommendations in the paper, and how she could have such dramatically different experience that fundamentally reconciles the risks of the new economy with new talent finance innovations that can actually propel her forward in career advancement and achieving opportunities. So we encourage you to read the paper, to get involved, to tell us your story, but please go read those 2 stories, because I think that will really bring it to life, what all this finance wonkiness means when it touches somebody's life in a concrete way, and how we need more of the Sarah stories, not the Robert stories. And we could do it. We could flip the headlines. We can be the change that we're looking for and we aspire to be, and we can do it together. So this is our effort in reaching out to you for you to join this movement. If we go to the next slide, I want to share with you what comes next. So we're just getting started. We kicked off with the release of the paper yesterday. We encourage you to share it far and wide. And we just had our kickoff event where we wanted to kind of give you the broad strokes of what this initiative and movement is all about. Next up on Thursday, we're going to have another forum. It's going to be down to 60 minutes, not 90. And it's going to be laser focused on building the partnerships of the future for the talent finance ecosystem. You're going to hear from more of our co-authors. You're going to hear from more panelists talking about why the time is now to build new public-private partnerships. Next week, we're going to dive deeper into the recommendations around the finance innovations for next Tuesday. And the following Thursday is going to look at the enabling infrastructure, topics such as quality assurance, HR accounting practices, emerging data infrastructure, the risk infrastructure of the future, all those things. So we're going to systematically move through the major themes of the paper. And we have a number of prominent speakers, some pre-recorded, some that will be doing live panel sessions, who are going to walk us through it. So take this journey with us, join us in this event series, and don't forget to join us in mid-October when we bring it all together in a capstone event to talk about all the things we learned through this event series and where we hope to take the movement next, and how you all could get involved in a series of design workshops to actually create the talent finance instruments and innovations of the future. So if you'd like to track the initiative, we have our URL there. So you're welcome to come and look at that. We have ways you can register for the events. We have access to the paper there now. You could download it. We will also be hosting content that's going to support our communication drumbeat. So do go in there and look at it. If you like some of the interviews you heard today, we have longer form versions of those that will be available. So you can get the complete interview, as well as new interviews that are rolling out, some of which aren't even going to be featured as part of this event, but we will have and will continue to build on as part of the overall movement. So that's what comes next. Thank you for your time today and joining us. I want to once again thank our core partners, the Federal Reserve Bank of Atlanta, the Greater Houston Partnership, as well as Working Nation, for contributing towards this initiative and the development of the white paper. Also wanted to thank our team and our leadership, and Suzanne for joining us today to kick off this event series, and thank all of you. We appreciate your time. We know it's valuable. You've been generous with us, and we hope you continue to engage with us throughout these next events, but more importantly thereafter, as we move from learning together to implementing together. Together, we can be a network of action. We could be the change that we strive for. So thank you, and be on the lookout for the recording of this event, as well as the slide deck that you could use as a resource going forward. So thank you very much, and we will see you all on Thursday.